Κυρίες και φίλοι, γεια σας. Σήμερα έχουμε την τιμή να έχουμε μαζί μας τον επικεφαλής οικονομολόγο και μέλος του Εκτελεστικού Συμβουλίου της Ευρωπαϊκής Κεντρικής Τράπεζας, τον κύριο Φίλιπ Λέιν, με τον οποίο θα συζητήσουμε για την πορεία του πληθωρισμού και την κατάσταση του τραπεζικού συστήματος έπειτα από κάποια γεγονότα στις ΗΠΑ. Mr. Lane, welcome. Well, I will get into the point. We've seen some recent banking failures in regional banks in the US, and along with the turmoil caused by Credit Suisse, created some concerns to depositors and investors alike over the safety of their deposits. Do you think there is a risk of these limited shocks turning into something systemic?
I think it's important for everyone to understand the differences between the euro area, Switzerland, and the US banking system. So in the euro area, we've had a very significant focus on making sure that the banks have high capital and liquidity ratios, that the banks are supervised in a strict way by the European Central Bank. And for these reasons, and also because we see that the European economy is performing relatively well. We now have the European economy expected to grow by around 1% this year. So under these conditions, of course, we look carefully, but our assessment is the euro area banking system is strong, it's stable, and it is not as vulnerable as some of the banks you mentioned to changes in interest rates, to changes in the economy. So for these reasons, we always are on guard, but I think everyone should understand the euro area banking system is in good shape.
Well, so you believe that there are no similarities between what happened in the US and the European banking system?
Again, let me emphasize that we are always looking closely, looking with great attention, but essentially because of the strict supervision, essentially because, if you like, European supervisors were on guard about the implications of rising interest rates for banks. I think it's becoming increasingly clear. Investors increasingly appreciate that the European banking system has, if you like, prepared and for the situation we face of rising interest rates. And these risks are well contained. And I think, again, for this reason, we should be confident about the state of the European banking system.
So you think that there is no problem of rising interest rates creating, let's say, what they call unrealized losses on the European banks' fixed income portfolio?
Now, this is one of the risks that is well understood, and exactly for this reason, it's important to pay attention that the size of the, if you like, the bond portfolio that a bank holds is not too big, that it's properly accounted for, it's properly managed, and that they have enough capital to guard against any loss in value of these bonds. And this is why, because of the supervision actions, because also from the point of view of the banks themselves, it would have been too risky to take chances on this. We do think this risk factor is quite contained. What I would say is, from the European Central Bank point of view, we've taken a step-by-step approach to, if you like, monetary tightening. Since around the end of 2021 to now, there has been a significant increase in interest rates, but it's been gradual, it's been step-by-step, and that has given the European system, I think, time to adjust to this change in the situation.
Well, Mr. Lane, following this turmoil, a lot of economists in the euro area have pointed out that we should reconsider implementing the European Deposit Insurance Scheme, the so-called EDIS, thereby completing the banking union. Do you agree with that?
I think we all share a common vision that where we want to end up is indeed a full banking union which includes EDIS, as you say, a European deposit insurance system. But I think everyone should recognise to arrive at that destination, it's a step-by-step process. It's important that there is momentum, that all of the prerequisites, all of the steps that are needed to deliver that need to be delivered. And as you know, this has been a conversation for the last number of years. I think what we've seen this year reinforces the value not only of a full banking union, but also a full capital markets union in Europe. So that vision, absolutely. But it's not a one-day decision, it's not an overnight decision. It's, I think, a lot of different elements need to be delivered for that to be achieved.
Well, let's turn to monetary policy now. The European Central Bank has raised its interest rates since July last year, 6 times if I'm not mistaken. And my question is, are we getting closer to a pause in rate hikes? Is monetary policy restrictive enough, or more hikes are needed to combat inflation in an effective way?
So I think we've been clear in our recent meeting, and again we made a further increase, as you say, in the March meeting, that a lot has been done. But we've also been clear that our next decision in May will depend on 3 factors. It will depend, if you like, on the inflation outlook, and every week, if you like, we have more information incoming in terms of the March inflation number that just came out. We will have the April inflation number as well before we meet in May. Number 2, we, if you like, have to diagnose the underlying dynamic, not just the overall inflation rate, but basically our kind of assessment of how quickly inflation is going to fall. Or conversely, if you like, the main concern would be if we assess that inflation was going to remain too high for too long. And then the third factor is how quickly these interest rate increases are restricting the economy and bringing down inflation. So for these reasons, we have no longer indicated or pre-announced, if you like, what the expectation is for the next meeting or for the upcoming meetings. And I think we will be looking very carefully at all of these data in the coming weeks. So I think it's important for everyone to understand, rather than asking me, if you like, what is the next interest rate decision, the focus should be on understanding every data point that comes in. So are we seeing signs that inflation is cooling? Are we seeing signs that interest rate increases are reducing, for example, credit, if they're leading to lower investment, lower consumption, lower pressure on the economy, and therefore lower inflation? And we still have quite a long way to go between now and the May meeting, about a month away. And so rather than, if you like, try and predict now what the decision will be, our attention will be on the incoming data, and we will analyse these, if you like, until the day of the meeting and make a decision then.
Okay. It's usually everybody continue to expect a rate hike on your behalf in the next monetary policy meeting. But okay, you said you didn't pre-announce it as the previous time. So I would ask, it's a rate hike but lower, or so where is the direction headed?
So I think that the best way to capture this is, I have said this and my colleagues I think have all said it, is in March we had a set of macro projections for the coming months. And if by the time of the May meeting those projections basically remain on track, then a rate hike will be appropriate. However, we need to be, if you like, scientific and data dependent. And so in these weeks, we have to see whether essentially the incoming data either support that projection from March, or if they create more inflation concerns, that will move us in one direction. if they create less inflation concerns, that will move us in another direction. So if you like, I think the formula would be, if the baseline we developed before the banking stress came along, if that baseline holds up, it will be appropriate to have a further increase in May. However, we need to be data dependent about the assessment of whether that baseline still remains at the time of our May meeting.
Well, there was a recent development, and I'm referring to the OPEC decision to reduce oil production, sending international oil prices soaring. I don't know, this development perplexes the ECB's monetary policy stance.
So the overall price of energy, the mix between oil, gas, electricity is of course a big part of the inflation dynamic. We will be, just in terms of energy, we'll have to weigh the movement in oil prices, and this should be seen in the context of a fairly large drop in recent months. This is some reversal of that trend, but in the context of a fairly negative trend. We've seen a very large reduction in gas prices. And if you like, the reduction in pressure from energy reduces the pressure on the rest of the economy. So not only the mechanical effect of energy prices, but one of the biggest issues for us is how the rest of the economy responds to the energy dynamic. Last year we had a lot of pressure on many sectors because their utility bill went up so much. This year with gas really improving quite a bit, with oil declining until quite recently, this will also relieve pressure on many sectors. So this is why it is really, I think, quite uncertain. This is why the data inflow is so important, because it's possible to debate many possibilities, and we really have to see in an overall context the net impact of these dynamics.
Well, and one last thing, there is a lot of criticism here in Cyprus, and I think elsewhere, that the ECB is proceeding with its monetary policy with rate hikes, disregarding the consequences on the real economy and the borrowers' ability to repay their loans. How do you respond on that?
So we work very hard to try and create balanced decisions. We fully take into account the impact of these interest rate increases on those who have debt, who face a bigger repayment challenge, the implications for investment, for households. But please remember, the reason why we are raising interest rates now is inflation is high. In order to make sure that inflation comes back to a low number, to around 2% our target, we do think it's necessary, it's unavoidable to make these interest rate increases. And if we did not do this, if we kept rates too low, we think inflation would remain too high for too long, and this will not serve anyone. It will mean it'll be, in fact, a tougher economic situation for a longer period of time. So a period now of raising interest rates is the best route to stability, is the best route to making sure the economy is in good shape and that the cost of living stabilizes. So it's, of course, difficult for those who were hoping for low interest rates, but this is an important episode. It's important for us at the ECB to make sure that the interest rate policy responds to the inflation challenge. And for those who express these concerns, I'm sure they share my conviction that all of us need to see inflation come back down to a low number around 2% as soon as possible.
And besides, high inflation would hit them from a different perspective.
So I mean, we here and elsewhere, I mean, those who suffer most from high inflation are those on low incomes, who face right now very high food prices, still absorbing the increase in electricity and gas prices last year. And it's in everyone's interest not to allow inflation to remain too high for too long.
Well, thank you very much, Mr. Léin.
Thank you.